Thank you for tuning in to leaddeveloper.com, where we simplify complex property development feasibilities, investment analysis, and everything real estate. Whether you're a seasoned pro or just starting out, our Google Sheets-based feasibility suite streamlines the toughest aspects of real estate. Lead Developer Feasibility Suite is trusted by thousands in over 17 countries. Our tools cover everything from quick assessments to detailed cash flow projections and more. Sign up today at leaddeveloper.com for unlimited free access to our expanding library of real estate tools. No credit card needed. Plus, get full support through Edge with step-by-step guidance, exclusive courses, and resources designed for your success. Turn numbers into narratives that win over investors and lenders. Join Lead Developer now.
Hey everyone, and welcome back for another deep dive. Today we're going to be tackling real estate investing.
Sounds good.
We've got a really comprehensive guide here, and I think it's going to be really interesting to kind of uncover the good, the bad, maybe even some strategies you haven't heard before.
Absolutely.
For building wealth through real estate. So
yeah, we'll kind of get into all the intricacies of real estate investing and, understand, the risk, but also, how to leverage, some of the advantages of real estate.
For sure. Okay, so let's start with the basics. What is real estate investing?
Real estate investing is essentially acquiring and managing and then eventually selling real estate for profit.
Okay.
So that could be like buying a house to rent it out, or it could be flipping a property for a quick gain, or even developing land.
Okay, and of course the profit part sounds really enticing.
Right.
But we need to talk about the risks involved.
Yeah, absolutely. Just like any investment, real estate comes with some inherent risks.
Okay.
One of those is financial risk. And that's the chance that the property, doesn't appreciate in value as you expected. Or even worse, you lose money.
So what would cause that to happen?
Well, a local economic downturn could lower property values. Unexpected repairs could drain your budget.
Yeah.
Or, difficulty finding tenants could really impact, your rental income.
Right. So it's not just about buying a property and watching the money roll in.
Right.
There are challenges that you have to consider as well.
Absolutely.
What other risks should we be aware
of? Another key risk is illiquidity.
Okay.
And unlike stocks, which are, very easily bought and sold,
right,
real estate is much harder to sell quickly.
Okay.
And that can be a problem if you suddenly need access to, your invested capital.
So you're saying it's not as simple as clicking a button to sell your investment.
Right.
What if you need that money, in an emergency or something like that?
Yeah. Finding the right buyer takes time, and sometimes you might have to accept a lower price than you want.
Okay. That's important to keep in mind. What about missing out on other investment opportunities? Because your money is tied up in real estate.
Yeah, that's called opportunity cost.
Okay.
And it's certainly something to consider because while your money is invested in real estate, you might be missing out on, potential gains in other markets like stocks or bonds.
So it's like choosing one path
right,
and missing out on another potentially.
Exactly.
Okay. What about inflation? How does that impact real estate investments?
Well, inflation can erode the value of your investment.
Okay.
So, for example, if the value of your property increases by, say, 3%, but inflation is at 4%, you've actually lost purchasing power.
Oh, so even if the numbers look good, inflation is kind of secretly eating away.
Right.
Okay. Wow. What about changes in laws or regulations?
Yeah, those fall under legislative risk and changes to property taxes, zoning laws,
right,
rent control policies, things like that could really impact your investments. Profit back.
For sure.
Yeah.
For sure.
Thanks.
Okay, so staying informed about local policies is really important, it sounds like.
Absolutely.
Are there any other risks that we haven't covered yet?
Yeah, there's economic obsolescence, and that's where a property becomes outdated and loses value.
Okay.
You can imagine like a beautiful office building in a location that suddenly becomes undesirable.
Right.
The building itself is fine,
Yeah.
but external factors have, diminished its appeal.
So it's not just about the property itself, but also what's context.
Exactly.
What if a neighborhood declines or a major employer leaves town?
Right.
All those kinds of things factor in as well.
Okay.
Okay. So we've covered a lot of potential downsides, but people keep investing in real estate.
Yeah.
There must be some compelling reasons why.
Absolutely. And, despite the risks, real estate offers some unique benefits that continue to attract investors. One of the biggest draws is cash flow, the steady income generated from rent payments.
Cash flow.
Yeah.
The lifeblood of any successful investment.
Right.
But that's different than profit, right?
Yeah, exactly. Cash flow is the money coming in, but profit factors in all your expenses.
Okay.
Your mortgage payments, property taxes, maintenance costs, insurance, and so on.
So you really got to keep an eye on those expenses
That's
to make
right.
sure that you're actually turning a profit.
Right.
Gotcha. What other benefits are there?
Well, as you pay down your mortgage, you're building equity in the property,
Okay.
increasing your ownership stake. And this can create a valuable asset that you can leverage for future investments or to, provide financial security.
Okay, so you're slowly gaining control of a valuable asset.
Exactly.
What about appreciation? Everyone talks about how real estate appreciates in value over time.
That's right. Appreciation is the increase in a property's market value over time.
Okay.
And historically, real estate has been a good hedge against inflation.
Right.
So as the cost of goods and services rises, so too do property values.
Yeah.
And that helps protect your investment.
It's like a built-in safeguard against rising prices.
Yeah.
That's reassuring. What about tax advantages?
Yeah. There are potential tax benefits associated with real estate investments.
Okay.
For instance, you can deduct expenses like mortgage interest, property taxes, depreciation from your taxable income.
Okay.
And then when you eventually sell a property, you might qualify for capital gains tax exclusions,
Wow.
which can significantly reduce your tax liability.
So you get to keep more of your hard-earned money.
Absolutely.
That's always good.
Yeah.
Are there any other financial strategies unique to real estate investing that we should know about?
Yes, there's refinancing.
Okay.
So as your property appreciates in value and you build equity,
Yeah.
you can refinance your mortgage to access that equity.
Okay.
And you can use those funds to, renovate the property or invest in other properties.
Right.
Or even pay down other debts. And in many cases, those refinancing proceeds are tax-free.
Oh, wow. Tax-free cash to reinvest.
Mm.
Okay. I'm also curious about the concept of leverage. How does that work in real estate?
So leverage is using borrowed money, typically through a mortgage, to control a more expensive asset than you could afford with cash alone.
Okay.
So for example, with a 20% down payment, you can buy a property worth 5 times your initial investment.
Oh.
And the idea is that, the property's appreciation and the rental income will generate returns that outweigh the cost of borrowing.
Okay, so it's like this financial tool to amplify your potential gains.
Right.
But of course, it could also amplify potential losses, right?
Exactly. Leverage is a powerful tool, but it needs to be used carefully and responsibly.
For sure. For sure. It's like a sharp knife.
Yeah.
It can be incredibly useful.
Yeah.
But also dangerous if not handled properly.
Okay, so we've explored the risks and rewards. Let's say I'm ready to take the plunge. What should I look for when choosing a property?
So that's where buying criteria comes in.
Okay.
We need to assess factors like property types, quality location, your intended holding period, and your desired return on investment.
Okay, let's break that down. When you say property types, what are the options? You have residential properties like single-family homes, condos, apartments.
Right.
Those are generally easier to manage but might offer lower returns than commercial properties.
Okay.
Then you have commercial properties. Those are retail spaces, office buildings, industrial warehouses.
Right.
And those can offer higher returns but often require more expertise to manage.
Okay, so it's like choosing between different asset classes with different levels of risk and reward.
Exactly.
What about property quality?
So properties are often classified using a system ranging from Class A to Class D.
Okay.
Class A represents the highest quality, typically newer buildings in prime locations.
Okay.
And as you move down the scale to Class D, you're looking at older properties that may require significant renovations.
Right.
Or are in less desirable locations.
Okay. And I remember you mentioned Class D properties earlier.
Yeah.
The ones some experts advise avoiding altogether.
Right.
What makes them so risky?
Well, Class D properties often come with a whole host of potential problems, from, deferred maintenance to just undesirable locations.
Right.
They might be tempting because of their lower purchase price, but they can quickly become money pits if you're not prepared for the extensive repairs and potential management issues.
So buyer beware.
Exactly.
It sounds like location is a key factor to consider.
Absolutely. Location can make or break a real estate investment.
Okay.
And factors like the local economy, the job market, schools, crime rates, access to transportation, the overall desirability of the neighborhood all play a significant role in a property's value and its potential to generate income.
So you have to think about not just where the property is now, but where it might be headed in the future.
Exactly.
Okay, so we've got property types, quality and location. What about my holding period?
Yeah.
How long do I plan to own this property?
So your holding period will really influence your investment strategy.
Okay.
Are you looking for a quick flip, buy, renovate, and sell within a few months? Or are you aiming for a longer-term investment, hold the property for years to generate rental income and benefit from appreciation?
So do I want to be a sprinter or a marathon runner in this real estate game?
Exactly.
And speaking of goals, how do I determine what kind of return on investment I should expect?
So your ROI, or return on investment, is the percentage gain that you expect to make on your investment.
Right.
So for example, if you invest $100,000 and you expect to earn $5,000 in profit each year, that's a 5% ROI.
Okay.
And calculating your potential ROI helps you evaluate different investment opportunities and assess whether they align with your financial goals.
So it's all about balancing the risk and rewards.
Yeah.
What level of risk am I comfortable with? What kind of return am I hoping to achieve?
Exactly. And remember, higher potential returns usually come with higher risks.
Right.
It's all about finding the right balance for your individual circumstances and investment goals.
This is all starting to make a lot more sense. Now that we've covered kind of the basics of buying criteria, let's dive into the different investment strategies that successful real estate investors use.
Sounds good. There's a whole world of strategies out there, each with its own advantages and disadvantages.
I'm ready to explore them. Let's get tactical.
Okay, so let's start with speculative investing. This approach involves purchasing property with the expectation that its value will increase rapidly in a short period.
So it's a bit like trying to time the market, hoping to catch that wave of rising prices.
Exactly. It can yield high profits if you get it right, but it's also inherently risky. You need a deep understanding of market trends and the ability to assess potential pitfalls.
It sounds like a strategy for experienced investors who are comfortable with a higher level of risk. What about something a bit more grounded? What's value-added investing all about?
Value-added investing focuses on identifying undervalued properties. These might be distressed properties or those needing renovation. The goal is to purchase these properties below market value, improve them strategically, and then sell for a profit.
So it's like finding a diamond in the rough, polishing it up, and then realizing its full potential. What kind of skills do you need to be successful with this strategy?
You need a keen eye for spotting hidden potential, the ability to accurately estimate renovation costs, and a knack for marketing the improved property to attract buyers.
It sounds like a blend of financial savvy and creative vision. What about investing in those high-quality Class A properties we talked about earlier?
That's a popular strategy for investors seeking stability and consistent returns. Class A properties are typically in prime locations, well-maintained, and attract desirable tenants.
So it's like investing in blue-chip stocks in the real estate world. You're looking for reliable long-term performance rather than a quick flip.
Precisely. These properties are less likely to experience dramatic fluctuations in value and can provide a steady stream of rental income.
That sounds appealing for investors who prioritize stability and lower risk. What are some other strategies investors use to maximize returns?
They're spinning off pieces of properties. This involves purchasing a property and then selling off portions of it. For example, you might sell unused land outbuildings or even air rights to generate additional profit.
So it's like maximizing the value of your investment by unlocking hidden assets. What about changing a property's use altogether?
That's called repositioning. It involves modifying a property to increase its value or appeal to a different market segment.
Can you give us an example of how that works?
Imagine purchasing an older office building in a transitioning neighborhood. You could convert that office space into residential apartments or even a mixed-use development with retail and residential units. This strategy requires careful market analysis and planning, but it can significantly increase a property's value.
So it's about adapting to changing market dynamics and finding creative ways to enhance a property's appeal. That's fascinating. What about strategies that cater to specific tenant needs?
There's rent-to-own. This allows tenants to rent a property with the option to purchase it later. It's a great option for tenants who may not qualify for a traditional mortgage right now.
So it's like a pathway to homeownership, allowing tenants to build equity while they rent.
Exactly. And for investors, it can provide a steady stream of rental income while potentially leading to a future sale.
Now let's talk about the classic fix and flip strategy.
This strategy involves buying a property that needs work, renovating it quickly and efficiently, and then selling it for a profit.
It's the strategy popularized by those home renovation TV shows. What are the keys to success with fix and flips?
Speed and accuracy are crucial. You need to accurately estimate renovation costs, Find reliable contractors, stick to a tight schedule, and effectively market the renovated property to potential buyers.
It sounds like a fast-paced and demanding strategy, but with the potential for substantial rewards.
Exactly. It's not for the faint of heart, but for those who thrive on action and enjoy the renovation process, it can be a fulfilling and lucrative endeavor.
What about wholesaling? How does that strategy work?
Wholesaling involves finding properties that are being sold below market value, often from motivated sellers. Instead of purchasing and renovating the property yourself, you contract to buy it and then quickly assign that contract to another buyer at a higher price, pocketing the difference.
So it's like acting as a real estate middleman, connecting sellers with buyers, and facilitating a profitable transaction.
Yeah.
What skills do you need to be successful as a wholesaler?
You need excellent networking skills, the ability to find and analyze undervalued properties, and a knack for negotiating win-win deals.
It sounds like a strategy for those who are relationship-driven and have a keen eye for market opportunities. What about lease options?
Lease options are similar to rent-to-own, but they give the tenant the option to purchase the property at a predetermined price during the lease term. This can be beneficial for both tenants and investors.
For tenants, it locks in a future purchase price, protecting them from rising property values. And for investors, it provides the potential for a future sale while generating rental income in the meantime.
Exactly. Lease options can be a flexible and mutually beneficial strategy.
With so many different strategies to choose from, how do I know which one is right for me?
That's a great question. The best strategy for you depends on your individual goals, risk tolerance, financial resources, and available time.
So there's no one-size-fits-all approach. It's about finding the strategy that aligns with my unique circumstances.
Precisely. Some investors prefer the stability of long-term rentals, while others thrive on the excitement and potential for higher returns from fix and flips. It's all about understanding the nuances of each strategy and choosing the one that best suits your needs and aspirations.
Now let's shift gears and talk about the legal aspects of real estate investing. What are the different ways to structure an investment?
One common approach is direct ownership. This means you own the property outright in your own name.
That sounds pretty straightforward. What are the benefits and drawbacks of this approach?
It's simple and gives you complete control over the property, but it also exposes you to personal liability and potentially higher taxes.
Okay, so there are trade-offs to consider. What other legal structures are available?
You could invest through a real estate investment trust, REITs. REITs are companies that own and manage income-producing real estate. By investing in a REIT, you're essentially buying shares of that company, which allows you to diversify your portfolio without directly owning or managing properties.
So it's like investing in a mutual fund for real estate.
Right.
What are the different types of REITs?
There are equity REITs, which invest in and own properties. Mortgage REITs provide financing for real estate. And hybrid REITs combine elements of both equity and mortgage REITs.
So there are options for different investment preferences within the REIT world. What about partnerships?
Partnerships allow you to pool resources with other investors, sharing the costs and responsibilities of owning and managing real estate.
It's like teaming up with others to achieve shared investment goals. What are the benefits of this approach?
Partnerships allow you to access larger investments, diversify your portfolio, and leverage the expertise and resources of your partners. However, it's crucial to carefully choose your partners and establish clear agreements to avoid potential conflicts.
That makes sense. Trust and clear communication are essential for successful partnerships. What about trusts? How do they work in the context of real estate investing?
Trusts are legal entities that hold assets for the benefit of a beneficiary. You can set up a trust to own and manage real estate, potentially providing tax advantages and asset protection.
So it's like creating a separate legal entity to manage your real estate holdings. Who manages the trust?
A trustee is appointed to manage the trust's assets and distribute income to the beneficiaries according to the terms of the trust agreement.
It sounds like a complex legal structure that requires expert guidance. When might a trust be a suitable option for a real estate investor?
Trust can be useful for estate planning, asset protection, and minimizing tax liabilities. However, setting up and managing a trust can be complex and costly, so it's important to consult with legal and financial professionals to determine if it's the right option for you.
With all these different legal structures, it seems like having a team of experts is crucial for navigating the real estate investment landscape.
You're absolutely right. A skilled real estate agent, a knowledgeable attorney, a reliable accountant, and potentially a property manager can provide invaluable guidance and support throughout your investment journey.
It's like assembling a team of specialists to help you navigate the complexities of the real estate world. Now, we've talked a lot about choosing properties and investment strategies, but what about managing risk once you've made an investment?
That's where diversification comes in. Just like with any investment portfolio, diversifying your real estate holdings can help mitigate risk and protect your overall returns.
So it's not about putting all your eggs in one basket. It's about spreading your investments across different properties and asset classes.
Exactly. Diversifying your real estate portfolio can involve investing in different types of property.
For example, a mix of residential and commercial properties.
Right. You can also diversify geographically by investing in properties located in different cities, states, or even countries.
So you're not tied to the economic fortunes of any one particular location. What other diversification strategies are there?
You can diversify by property class, investing in a mix of Class A, B, and C properties to balance risk and potential returns.
So creating a well-rounded portfolio that includes both stable and potentially higher growth investments.
Exactly. And you can diversify by investment strategy, combining long-term rentals with fix and flips or other approaches to spread your risk and potentially maximize your returns.
So diversification is like building a strong foundation for your real estate empire. It helps to weather any storms that may come your way.
Well said. By spreading your risk, you're creating a more resilient portfolio that's better positioned to withstand market fluctuations and achieve your long-term investment goals.
Now, with all this information about risks, benefits, strategies, and legal structures, what's the secret sauce to success in real estate investing? What separates the winners from the also-rans?
In my experience, the most successful real estate investors share 3 key traits: thorough research, a deep understanding of market cycles, and the ability to make informed, data-driven decisions.
Okay, let's unpack those traits. Why is research so crucial in real estate investing?
Thorough research is the foundation of any successful investment. Before committing your capital, you need to thoroughly investigate the property, the neighborhood, the local market trends, and the potential risks involved.
So it's not just about falling in love with a charming house or a trendy neighborhood. It's about digging deep and understanding the numbers, the dynamics, and the potential pitfalls.
Exactly. You need to analyze comparable properties, research recent sales data, assess the local rental market, and understand the legal and regulatory landscape.
It's like conducting a thorough due diligence process before making any major business decision.
Precisely. Knowledge is power in real estate investing, and thorough research empowers you to make informed and strategic decisions.
What about understanding market cycles? How does that contribute to success?
Real estate markets, like all markets, go through cycles of expansion and contraction. Understanding where you are in the cycle can help you make more strategic decisions about when to buy, sell, or hold properties.
So it's about recognizing kind of the ebb and flow of the market and positioning yourself accordingly.
Right. If you're buying in a rising market, you need to be prepared for the possibility of a future downturn. And if you're selling in a declining market, you may need to adjust your expectations and pricing strategy.
So being proactive and strategic, not reactive and emotional.
Exactly.
And finally, what about making informed decisions? What does that entail in the context of real estate investing?
Informed decision-making is about removing emotion from the equation and relying on data analysis and a clear understanding of your investment goals.
So you're not making impulsive purchases based on gut feelings or emotional attachments.
Precisely. It's about carefully evaluating the numbers, assessing the risks, and making calculated decisions that align with your overall investment strategy.
It's a very disciplined approach.
Yeah.
You have to prioritize logic and objectivity over emotional impulses.
Exactly. Successful real estate investors are able to detach themselves emotionally from the properties they're considering and make decisions based on a rational assessment of the facts and figures.
So you're treating real estate investing like a business, not a hobby or an emotional pursuit.
Right. By combining thorough research and understanding of market cycles and a data-driven decision-making process, you can significantly increase your chances of success in the dynamic world of real estate investing.
Those are some incredibly valuable insights.
Yeah.
Now, I want to circle back to something we touched on earlier, those Class D properties that come with a higher level of risk.
Yeah.
Can you elaborate on what makes these properties so potentially problematic for investors?
Of course. Remember, Class D properties are typically at the bottom of the real estate hierarchy.
Right.
They often suffer from a combination of negative factors that make them challenging investments even for experienced investors.
So we're talking about the real estate equivalent of a fixer-upper on steroids.
Yeah.
What are some of the red flags that scream Class D?
One major concern is poor construction quality. These properties may have been built hastily or with substandard materials, leading to structural issues, leaks, mold, and other problems that can be costly and time-consuming to repair.
Oh, so it's like buying a house of cards.
Yeah.
That's one strong wind away from collapsing.
Another common issue is severe deferred maintenance. Class D properties have often been neglected for years, resulting in a backlog of repairs that can quickly drain your budget.
Wow. So you're not just buying a property, you're inheriting a to-do list a mile long.
Exactly.
Yeah.
You might encounter outdated plumbing electrical systems, roofing, HVAC appliances that all need immediate attention.
And those costs can add up fast.
Absolutely.
It's like playing a never-ending game of fix it or flip it.
Then there's the challenge of undesirable locations. Class D properties are frequently found in neighborhoods with high crime rates, poor schools, limited access to transportation, and other factors that make them unattractive to tenants or buyers.
So it's not just about fixing up the property itself.
Right.
It's also about contending with the challenges of the surrounding neighborhood.
Exactly. Attracting quality tenants or buyers in these areas can be incredibly difficult, and you may have to offer significantly lower rents or sale prices, which can erode your profit margins.
It's like trying to sell ice cream in Antarctica. Are there any other concerns associated with Class D properties?
Yes, they often have a history of management issues. They may have been owned by absentee landlords who neglected maintenance, leading to tenant complaints, code violations, and even legal problems that you'll inherit as the new owner.
So you're not just buying a property, you're buying someone else's headaches.
You might find yourself dealing with evictions, lawsuits, and other legal entanglements that can be time-consuming, stressful, and expensive.
It's like stepping into a real estate minefield. With all these potential pitfalls, why would anyone even consider investing in a Class D property?
The primary allure is the potential for high returns. Because these properties are often sold at steep discounts, there's an opportunity to buy low, renovate strategically, and sell high for a substantial profit.
So it's like a high-stakes game of real estate poker.
Yeah.
Where the risks are high, but the potential rewards are even higher.
Exactly. But it's a strategy that demands a deep understanding of the market, a high tolerance for risk, and a realistic assessment of the costs and challenges involved.
So not a strategy for the faint of heart,
right,
or the inexperienced investor.
Absolutely. It's a niche market that requires specialized knowledge, experience, and a willingness to navigate complex situations.
What advice would you give to someone who's considering dipping their toes into that Class D property pool?
First and foremost, do your homework. Thoroughly research the property, the neighborhood, and the local market.
Don't just rely on the seller's promises or a quick glance at online listings.
Right.
Dig deep, gather evidence, and seek expert opinion.
Exactly. Get a professional inspection to uncover any hidden problems, consult with a real estate attorney to review any existing legal issues, and talk to experienced investors who have successfully navigated the Class D market.
It's like assembling a team of advisors
to
help you assess the risk and opportunities.
Precisely. Informed decision-making is crucial in this market, and having expert guidance can help you avoid costly mistakes.
What other tips do you have for minimizing risk when investing in Class D properties?
Be realistic about your renovation costs. Get multiple bids from contractors, factor in a contingency for unexpected expenses, and make sure you have sufficient capital to cover the project without putting your finances at risk.
So don't underestimate the scope of the work
Right.
or the potential for unforeseen expenses.
It's essential to have a solid financial plan in place before embarking on a Class D renovation.
What about having a clear exit strategy?
That's crucial. Before purchasing a Class D property, determine how you plan to sell or rent it once it's renovated. Research comparable properties in the area, set a realistic sale price or rental rate, and develop a marketing plan to attract potential buyers or tenants.
So you got to have that roadmap in place
Yeah.
for how you'll eventually realize a return on your investment.
Precisely. Investing in Class D properties can be profitable, but it requires careful planning, thorough research, and a willingness to navigate the inherent risks.
It's like embarking on a challenging expedition. You need the right gear, a skilled guide, and a healthy respect for the potential dangers.
Well said. Now, with all that said, I want to emphasize that Class D properties are not for everyone. They represent a niche market that demands specialized knowledge, experience, and a high tolerance for risk.
So not a typical starter investment.
Right. If you're new to real estate investing, I generally recommend starting with more stable and predictable properties like Class A or B rentals to gain experience and build your confidence before venturing into the more volatile Class D market.
It's like learning to swim in the shallow end before diving into the deep end.
Precisely. Real estate investing can be a rewarding journey, but it's crucial to choose investments that align with your risk tolerance, experience level, and long-term goals.
Now, I want to shift our focus to the ownership cycle.
Yeah.
Can you walk us through the different phases of property ownership and how investors can strategically navigate them?
Absolutely. The ownership cycle typically involves three main phases: acquisition, holding, and disposition.
Okay, let's break that down. What happens during that acquisition phase?
The acquisition phase is all about finding and purchasing the right property. It involves conducting thorough research, identifying potential investment opportunities, analyzing financial data, negotiating purchase agreements, and securing financing.
It's like embarking on a treasure hunt,
Yeah.
searching for that hidden gem that meets your investment criteria and fits within your budget.
Exactly. During this phase, you need to be meticulous and scrutinize every aspect of the property and the deal. Don't rush into a purchase without conducting due diligence and ensuring that it aligns with your overall investment strategy.
So you got to be patient, discerning, and strategic
Absolutely.
in your property search.
Right.
Once you've successfully acquired a property, you enter that holding phase.
Right.
What are the key activities and considerations during this phase?
The holding phase involves managing the property, collecting rent, handling maintenance and repairs, and hopefully watching your investment appreciate in value.
So it's like becoming a ship captain.
Yeah.
You're steering your investment through calm waters and stormy seas, making sure it stays afloat and reaches its destination.
Exactly. During the holding phase, you need to be proactive, responsive, and strategic in managing your property to maximize its potential. This involves carefully selecting tenants who will pay rent on time and take care of the property, staying on top of maintenance and repairs to keep the property in good condition, and attract quality tenants, staying informed about market trends and adjusting your rental rates or sale prices accordingly, and being prepared to weather any storms that may come your way.
So the holding phase requires a blend of hands-on management, market awareness, and financial prudence.
Absolutely. And finally, we come to the disposition phase, which involves selling or otherwise disposing of the property.
So this is where you cash in on your investment and sail off into the sunset.
Well, hopefully. The disposition phase requires careful planning and execution to maximize your returns.
What are some key considerations during this phase?
You need to determine the optimal time to sell to maximize your profits. Prepare the property for sale, which may involve renovations or staging market the property effectively to attract potential buyers, negotiate the sale, and handle the closing process smoothly and efficiently.
So the disposition phase is all about orchestrating a successful exit strategy.
Exactly. By carefully planning and executing the disposition phase, you can reap the rewards of your investment and set yourself up for future success in the real estate market.
Navigating that entire ownership cycle successfully requires careful planning, diligent execution, and a willingness to adapt to changing market conditions.
Well said. And remember, real estate investing is a journey, not a destination. Enjoy the ride, learn from your experiences, and keep your eyes on the horizon.
Speaking of the journey, let's talk about the role of real estate professionals. Who are some of the key players that investors should have on their team?
A skilled real estate agent can be invaluable. They can help you find properties that meet your investment criteria, negotiate purchase agreements, and guide you through the intricacies of the transaction.
So they're like a matchmaker connecting buyers and sellers and ensuring a smooth process. Who else should be part of my real estate dream team?
A reputable real estate attorney can help you review contracts, ensure you're legally protected, and handle any legal matters that may arise during the course of your investment.
Okay, so they provide that peace of mind.
Exactly.
Knowing that you have expert legal guidance every step of the way.
Right.
What about evaluating the condition of a property?
A qualified home inspector will conduct a thorough examination of the property, identifying any potential problems or areas of concern. Their detailed report can help you make informed decisions about repairs, renovations, and potential deal breakers.
So it's essential to get that health check for the property before making a commitment. And of course, financing is a major part of real estate investing.
Right.
Who can help me navigate that?
A mortgage broker or lender can help you secure financing for your investment property. They can shop around for the best interest rates and loan terms to fit your financial situation and goals.
So they're like financial navigators,
Right.
helping you chart a course through that mortgage landscape.
Exactly.
Now, let's say I've purchased a property and I'm ready to start generating rental income. Is there anyone who can help me manage those day-to-day operations?
Absolutely. A property manager can handle everything from finding and screening tenants to collecting rent, coordinating maintenance, and addressing any tenant issues that arise.
It sounds like they really take the hassle out of being a landlord,
Yeah.
allowing me to focus on the bigger picture. Having a strong team of professionals can make all the difference in my real estate journey. It's like having a pit crew for my investment car, keeping it in top shape and ready to race towards success.
That's a great analogy. Each member of your team brings specialized knowledge and expertise to the table, helping you make informed decisions and navigate the complexities of the real estate world.
Now, before we wrap up this deep dive, I want to touch on something that's important to me: ethics in real estate.
Okay.
How can investors ensure that they are operating ethically and responsibly?
Ethics should be a guiding principle in every business endeavor, and real estate is no exception. It's not just about making a profit, it's about doing business the right way.
So what are some key ethical considerations for real estate investors?
Honesty and transparency are paramount. Be upfront with sellers, buyers, tenants, and all stakeholders. Treat everyone fairly and with respect.
That sounds like a solid foundation for ethical conduct.
Absolutely.
What else should we keep in mind?
Fulfill your obligations and commitments. Honor your contracts, pay your bills on time, and follow through on your promises. Maintain your properties responsibly, keeping them safe and habitable.
So it's about being a responsible property owner?
Right.
And a good member of the community. Are there any other ethical considerations that we should be aware of?
Absolutely. Strive to make a positive impact on the community. This could involve investing in neighborhoods that need revitalization, supporting local businesses, or contributing to community development initiatives.
So ethical behavior not only benefits the community,
Right.
but also enhances your reputation as an investor,
Ex-
which can lead to greater long-term success.
Investors who are known for their integrity and ethical conduct attract more business opportunities and build stronger relationships within the industry.
Well, as we reach the end of this deep dive into the world of real estate investing, I want to leave our listeners with a final thought. Now that you have a taste of this real estate landscape, what type of property or strategy sparks your interest? Perhaps it's time for your own deep dive into a specific neighborhood or investment approach.
Remember, the world of real estate investing is vast and varied, offering countless opportunities. The key is to find a path that aligns with your passions, your skills, and your financial goals.
Whether you're drawn to the stability of rental properties, the excitement of flipping houses, or the long-term potential of land development, there is a place for you in this real estate game.
As always, we encourage you to keep learning and exploring. The more you know about real estate, the better equipped you'll be to make smart decisions and turn your investment dreams into reality.
That's a perfect note to end on. Remember, folks, knowledge is power, and we're here to empower you to become well-informed on any topic that piques your curiosity. Until next time, keep diving deep,